2, Intermediate Bond Math. We're going to speak today about the economics and structures. Again, Louis Choi is our speaker. I want to welcome all those back who participated in Part 1. I'm going to run through a couple of housekeeping items for those that are new. Presentation slides are available on the CDAC website. The URL is posted on the slide in front of you. Captioning is also provided during the program. Participants may click on the link in the chat section at the bottom of the control panel to access remote captioning. For the audience, if you want to submit questions throughout the webinar, type the text in the box marked question near the bottom of the GoToWebinar control panel. We'll try and field those through the course of the presentation and direct those to Louis, and hopefully he'll be able to integrate them in the presentation. If you've got particular questions on slides, you'll want to get those to us as quickly as possible so we can address them. Those requiring a certificate of attendance, you must be registered and logged into the webinar under your own name. Certificate will be emailed to all the participants within the week. For MCLE credit, please email CDAC at cdac_education@treasurer.ca.gov. We'll get one out to you. We're gonna switch the slide here, if we could do that, to identify CDAC's upcoming events. That was already listed. Thank you. Okay, well, I'll be brief about those. We've got a seminar on special assessments in Sacramento, September 18th through the University of California, Davis Extension. We've got a pre-conference program at the California Public Finance Conference hosted by Bond Buyer in October 8th. We're going to focus on alternative financing in the municipal market. Lastly, we have a webinar on the principles and practices of debt management, particularly employing a debt management policy and the importance of debt management policies in managing your debt program. That's to be held Wednesday, October 22nd. Again, for further information on CDAC seminars and program, please visit our website. All right, with that, I'm going to turn this over quickly to Louis Choi. We've got a lot of content, and I will give a brief introduction. Again, for those who are attending this, having done the first part, you know Louis, Senior Manager Director with Prague, joined the firm in January 2005 and serves as the primary investment advisor for Prague's Los Angeles office. Louis has quantitative analytic experience, including forward starting swap pricing models, tracking historic performance of municipal variable rate securities versus various swap indices, and structuring refundings with derivative products. Prior to joining Prague, Louis was an investment banker in the public finance departments of 2 national investment banking firms. Again, Louis, thanks for doing this. I'm going to turn it over to you and let you go.
Thank you. And welcome to everybody who is joining us, and welcome back to those who were participants in the first part of the Intermediate Bond Math webinar. Before I begin, I want to point out that a number of the things here is going to be building upon some of the mathematics and methods that were described in the first webinar. And especially for those who were not able to join us last time, I would strongly encourage you to go back and look at some of those to try to fully understand what is being presented here. And where we make extensive use of that material, I'll try to point a bit of it out, and hopefully it will not be too much of a leap for most folks to understand some of the things that will need to just sort of been accepted or assumed to be true. Without further ado, I do not seem to have control over the slides. Oh, yes, I do. Okay, now I do. Okay, the first thing I just want to lay out the topics that we're going to cover for this part 2 of the Intermediate Bond Math webinar. One of the fundamental things in comparing a lot of the economics related to municipal bonds is to really understand how refunding economics works. And so we're going to begin as the first topic is by talking about how refundings work and how to calculate some of the economics related to that. And then we're going to apply those principles and as well as some of the things that were from the previous webinar to talk about the economics of callable bonds, and then subsequently comparing them to non-callable bonds, and finally to cover some of the implications of using capital appreciation bonds or CABs as well as convertible CABs. And as a bonus, we wanted to talk a bit about how people go about valuing call options briefly so that the audience can be familiar with some of the tools that people use to evaluate that very important decision. And as was stated before, we encourage you to ask any questions in between the webinar, during the webinar, and the amount of content for the second webinar is a bit shorter than the first one. And if anybody does have any questions related to the content of the first webinar, I'll be happy to address them at the end of this one and probably right before we get to the bonus material. Okay? Starting with refundings. Are you sure I have control over the slides?
Louis, click on the presentation itself. That, I think, renders control back to you.
I did do that, but it's not. Something is missing here. Yeah, the mouse is not following my mouse.
Can you try?
Give it a try now.
Okay. Okay, it should be working now. Perfect.
Okay, great.
Okay. So first topic I want to cover is how refundings work. And here we have an example of cash flows related to a refunding, and similar to how we had gone about doing a lot of our analysis for the first webinar, we're going to start with talking about how refinancing for savings work with respect to a loan. And the format is should be a bit familiar to those who had joined us last time in terms of how some of this looks. And we're going to start, like I said, with a loan and look at the economics from there, and then build from there to illustrate how the example applies to municipal bonds. We begin with this particular example to have a $50 million outstanding balance for the loan that was to be repaid in 5 years and had an original interest rate of 5%. And then we would refinance it with a new interest rate of 3%. That's a typo, as opposed to 4%. It's really supposed to be 3%. And then having refinancing fees of $500,000. You'll see in the boxed area there, where my arrow is pointing, the cash flows for what the original loan looks like, amortizing the principal for the $50 million, as well as the interest related to that. The interest goes down as principal is repaid. You sum those up to get the debt service. That's what you have to pay for the original loan. And after the refinancing, in order to pay for a refinancing fee of $500,000, we would end up with a larger starting principal amount. So as opposed to $50 million, $50 million, $500,000. But then there is a different amount of interest that's calculated on that because the rate is different. And the sum of that principal and interest is the debt service. And when you compare the two debt service schedules, you see the savings there. And that's what we're talking about. And that's traditionally what you would expect to see in terms of refinancing for loan, be that a house, a car, or what have you, credit card fees, for instance. And it's entirely conceivable that the amount of principal upon the refinancing will have to go up slightly. But one is able to realize savings as long as the difference in interest is sufficient to cover that increase in principal. And that's exactly what we see here in this example. And so this is how refinancing for a loan works and how one generates savings by moving from a higher to a lower interest rate, even as the principal amount goes up slightly. And bonds are very similar to this. And as we go through and make the adjustments to show how it works for bonds, you'll see many of the same principles at work. So right off the top, we're going to do a number of different conversions, and this was all laid out basically in slides 21 through 27 of the Intermediate Bond Math Part 1 webinar, where we take it from a loan to represent a series of bonds by reflecting the different conventions and other things that relate to bonds. For instance, one of those things is that, for bonds, for municipal bonds, we're typically dealing with a denominations of the multiples of $5,000, and then we've gone about doing that here. So as opposed to $50 million in various dollar amounts and cents that were being repaid before, now that they're just being done in steps of $5,000. That goes both for the original and for the new loan, the new bonds, if you will. We also introduced the fact that they have multiple different interest rates for bonds, because a lot of times you are refunding a whole series of bonds. That's different than a typical loan where there was typically only one interest rate. But here you'll see that consistently we're replacing some higher interest rates with lower interest rates. And then on top of that, we've made some additional calculations to reflect proceeds based on coupons and yields. And in this particular example, for right now at least, we kept the coupons and yields identical, so all of the prices would be 100% of the respective principal amounts, and so the proceeds would be perfectly equal to the principal amount in each and every maturity. We also would make adjustments of cost of issuance, underwriter's discount, and things of that sort to get things to balance. The proceeds here tie directly to the sources of funds. The cost of issuance and the underwriter's discounts are deducted from those available proceeds to try to generate a net proceeds amount such that it's sufficient to pay off the previous loan or the previous principal amount. And that, we've done a number of steps here very quickly, but really, we went through last time in part 1, going very step by step to make that conversion from loans to bonds. And in a refinancing, those same kind of principles exist when one looks at bonds rather than a loan. But we sort of summed it up in one step here on this slide. And again, we're able to see that, as long as the interest amount has been reduced, we are able to generate savings, even though the new principal amount of $50,350,000 is more than the old principal amount. That's okay, because the interest savings is around $3.4 million, and even after accounting for that difference in costs, we're able to generate savings of roughly $3 million. Now, one of the things that we know is true for municipal bonds is that often they don't price at par, and that was also one of the things that we just discussed the last time. And it's actually possible for one to be issuing, and frequently true, that one issues coupons that are in excess of the yield. So here we are adjusting the coupons of the scenario. So in this middle yellow area here, where as opposed to having only par bonds where the coupons match the yields, we now have coupons that are substantially higher than the yields. And as a result of that, the interest calculation goes up significantly, but also the proceeds, the prices of the bonds go up a lot, such that one would issue, in this scenario, after moving to these higher coupons, only $46.9 million in principal, one is able to net $50.3 million of proceeds in all by calculating each of the prices based on the coupons and yields and maturity dates and so forth, which is, again, something we had discussed back in the first webinar, and calculating those prices, applying those prices to each respective principal amount to get to the proceeds, and summing those up. And here you'll see that the difference between the principal and the net and the proceeds is what's known as the net original issue premium, and and as a result of that, we're able to reduce the principal amount we've issued. And because of those two things, even though the coupons for the new loan, for the new series of bonds, is higher than the old coupons, one is still able to generate savings by virtue of the fact that the additional proceeds generated as a result of issuing premium bonds allows one to issue a smaller amount of bonds. And what we learned from this example is that it's rather the yields of the replacement bonds that are the determining primary driver for how much savings is generated rather than the coupons themselves. And that, the offset is the increase in coupons, increased prices, you allow less principal to be issued, and that's how the debt service savings is generated. At this point, I'll pause for a second in case anybody has any questions about any of this. This would seemingly cover a lot of material, but a lot of it, like I said, really was part of the previous webinar.
Louis, we don't have anything for you at this time.
Okay, that's fine. Thank you. One of the things that gets done with these results often is that we're asked to create a single number rather than a series of numbers to represent the savings. Whereas the cash flow savings, which is what we were seeing before, the savings on not the very, very far right, but near the far right, the second to last column here, that is the difference in the debt service between the beginning, from the previous loan to the new loan, is a very important metric, especially from a budgetary perspective. Oftentimes, we're asked to sort of represent the savings level in aggregate and to take into account everything. And so what one does is calculate what's known as the net present value savings, so NPV savings, which takes into account the time value of money of the savings pattern. That is, the savings at a later date, even though it's the same nominal dollar amount, when it's savings that doesn't get realized for a long time from now, until a long time from now, it's probably not quite as valuable as a near-term savings. So this goes back to the time value of money discussion we had, once again, in the first webinar, and tries to accumulate all of those numbers into a single form, as well as to take into account any contributions, as well as resulting funds on hand that might be generated upon the refunding. And a lot of times these funds on hand and resulting funds on hand do appear both because of tax rules, arbitrage regulations, which require one to apply any funds they have from prior deals into the new transaction, into the refunding transaction. So you might have to, money that one has on deposit with a trustee, for instance, that dedicated debt service might have to be contributed into the transaction, as well as new amounts of money might be generated for security features, such as having a debt service reserve fund on hand and things of that sort. And the net present value savings calculation is an attempt to capture all of those things all rolled up into one number. So here we have an example of doing that. Once again, we have the same original loan, the new loan, those cash flows, what those look like, the savings being the difference between the debt service of the two columns. And then we're able to apply a discount rate and to take the present value of each and every single one of those savings cash flow payments, and then to add them up to come up with one component of the net present value savings, so the present value savings from cash flow, which goes here, and then also to take into account any contributions that we made initially into the transaction. In this case, we had some original funds on hand. We applied them and added it in as an additional source of funds. So we deduct that from the amount of savings, because the savings that's associated with a reduction of in $11.5 million of contribution. By contributing money, we're able to issue effectively $11.5 million less of principal. So one would expect there to be a reduction in debt service as a result of that. But that's really just spending money you already have. So as opposed to fully counting that the cash flow savings related only to that component, one is supposed to take into account you're putting money in, therefore that's not true savings. So we put that in.
Louis,
Sure.
I've got a question going back to the former slide, but it probably applies to this as well. Your amortization of the loan assumes a flat amortization schedule.
Yes.
All right. Then I've got two more, and they apply to this. The appropriate discount rate that you're using for the present value calculation is what? And then secondly, what rate is used for the discount factor for the net present value?
It's the same rate that's being used to do the discounting, and the convention for doing this discounting, doing this present value discounting, is to use the current cost of capital for the issuer, which is imputed by basically what your borrowing cost now is for the new loan. So generally, by convention, the default is to use the arbitrage yield related to the new bond deal. But there are variations on that. Some people use true interest cost. Some others use all-in true interest cost. But really, generally speaking, people use the arbitrage yield for the new transaction. And that's actually what was done here. I might have done the TIC for this one, the true interest cost. But that's generally what is used and to do the discounting. Okay? And so because these funds on hand came into the transaction, so those don't get counted as part of the savings. But at the same time, anything you generate as a result of the transaction, so now because you've done the new bond transaction, there might have been required a new reserve fund, for instance. The reserve fund deposit would be available in the future to, at the very least, to pay the very last debt service payment. And it could also earn money and all that kind of stuff in the interim, as well as any contingency amount that might be generated, because really, if the cost of issuance covers everything that you need to pay for, this really becomes free cash flow that's available, not that that's very much. But all of those things are accounted for by either subtracting or adding them in against the present value of the cash flow savings to arrive at the net present value savings. And oftentimes, this net present value savings is divided by the original principal amount to get a sense as to how successful the refunding was on a relative basis. You can compare across time, across size of transactions and things of that sort as a percentage on a percentage basis, so NPV savings percentage. And you hear that and you see that oftentimes in cash flows all the time. Are there any other questions related to this slide and how net present value savings is calculated, or anything related to some of the refunding cash flows that goes into all this?
Yeah, this goes back to part one, but you might want to summarize the difference between true interest cost and all-in true interest cost.
To arrive at, so what true interest costs and all true interest costs are attempts to represent the entire borrowing cost of a transaction as a single percentage number, if you will. And the way to do that is to discount the debt service related to the entire issue at a rate, so either at the true interest cost or all-in true interest cost, such that the present value of the debt service at that rate equals a target number. The difference between true interest cost and all-in true interest cost then is really what that target number is. And typically that target number is based on the proceeds one receives. And in the case of a true interest cost, it is the net proceeds, so principal plus net original issue premium minus the underwriter's discount. That's what to set the target amount. That's what it is for true interest cost. And in the case of all in true interest cost, it's the principal plus the net original issue premium or minus net original issue discount, if that's the case. But also minus not only cost of issuance, not only underwriter's discount, but also cost of issuance. And the net effect of that is that in general, the all in true interest cost is slightly higher because your target number is lower. That means your discount rate has to be slightly higher to get that. So both of them are representations of the borrowing cost of a transaction as on a percentage, in a percentage terms. That's what those are. Are there any questions?
No.
Okay. So this is how you go about calculating net present value, savings, taking account, everything. And these few slides, these last 2, 3 slides, 2, 3, 4 slides, are really encapsulate what the cash flow such adjustments or additional schedules and statistics and other things one will see to encapsulate what a current refunding is. And the next topic we're going to talk about is really advanced refunding, which introduces even a bit more complication and a bit more math. But before we talk about the specifics of that math, let's just all be clear about exactly what an advanced refunding is. And it starts on the next slide. An advanced refunding is really a term that comes from tax law and arbitrage regulations, and it's defined formally to be a refunding in which new bonds delivered more than 90 days in advance of the call date of the old refunded bonds. And as a result of that, and how one would generate the most economics as well as special IRS rules and things of that sort, it's necessary for one to establish an escrow to fund the principal and interest due on the old bonds in the period between the delivery of the new bonds as well as and the call date of the old bonds. So, because in reality, even though in an advanced refunding, from an issuer's perspective, for the most part, one's obligation to pay the old bonds have extinguished, the old bonds actually continue to exist until they are redeemed, where an investor holding the old bonds will continue to receive interest that they accrue until the date that were called. So what we see is, and this is diagrammed in the 3 graphs before, is that before the refunding, an issuer has to be paying debt service on the old bonds. And in the period between the delivery of the new bonds and the retirement of the old bonds, their debt service of the old bonds has to continue to be paid. But the issuer doesn't want to have to pay debt service on both the new bonds and the old bonds. So what he does is he issues the new bonds and moves the proceeds of the new bonds into an escrow account, and the escrow account is structured such that it will be sufficient to pay for the entire amount of debt service due on the old bonds, so that the issuer is left only with the obligation to pay debt service on the new bonds. And then after the call date, when the old bonds disappear entirely, so this blank spot here, the issuer goes along his merry way to just pay debt service on the new bonds, and that's it. And that's what an advanced refunding is. And in terms of mathematics, and you know, it's certainly possible to do a similar thing for current refunding, which is where the new bonds delivered less than or equal to 90 days before the call date of the old refunded bonds. But the economics there isn't as important because the period of overlap is generally smaller. The investment opportunity for investing for only 90 days is smaller. But for an advanced refunding, the advanced refunding could be far out into the future. A lot of times, municipal bonds are traditionally structured with 10-year calls, and it's possible 5 years in to do an advanced refunding where you would have to establish an escrow that lasts for 5 years before the old bonds are retired. And so in that case, there's a lot more opportunity for investment. There's a lot more opportunity for overlap of the two bonds being in existence at the same time. So math-wise, this introduces an additional level of complexity. And not that, the previous slide wasn't busy enough. I've decided to add more things to this to represent that. And what this is really that one has to account for that escrow step that's involved. And a lot of the mathematics related to the escrow step is very, very, very similar to how we do calculations for the bonds themselves. And it's not really that different. It's just a reappropriation of the same principles and methods and putting a slight twist on it to get you where you need to go. And that escrow part is shown in the middle yellow box there. And starting with the left-hand side, essentially one of the first thing one needs to do is, in this particular example, we're going to call the bonds. We originally delivered the refunding bonds on May 1st, 2014. We're not going to be able to call the original refunded bonds until May 1st, 2015, so 1 year later. So what one needs to do then is to calculate the precise amount of principal they need to pay on 5/1/2015, as well as how much interest they have to pay in the interim from the delivery date of the new bonds to the call date of the old bonds, so from 5/1/14 to 5/1/15. And when you add up that principal and interest requirement, that's what we call the escrow requirements. And then what one has to do is to find out how one would structure an escrow as to be able to have the escrow fully be sufficient to make all of the payments that are due on the old bonds, so that the issuer will no longer have to be responsible for it. And to do that, that is very much similar to how one goes about calculating debt service on the on any kind of bond, on any series of bonds, because here basically what we're doing is the issuer is going to go out and buy a portfolio of securities, or rather a series of treasury bonds, if you will, that will pay out debt service such that the amount of debt service to be received on those treasury securities would be exactly equal to the escrow requirement, and therefore allow them not to pay any of the debt service. And this is what you'll see here, is that the cash flow from the securities is exactly equal to the escrow requirement. So 1190925 appears on November 1st, 2014 in both places, and $51,190,925 appears on May 1st, 2015 in both places. And how do you go about doing that is you have to buy securities that both bear interest and pays out in principal, and the sum of these two things equal what your cash flow needs to be, and you can calculate how much it costs to buy those securities if those securities will have different yields and coupons. In this particular example, they don't, and typically, a lot of times it doesn't, because a lot of people use the state and local government series of treasuries, or what's known as slugs, to do this. And then that becomes what your the summation of that cost becomes the amount of deposit you'll need to put in order to fund to establish a escrow of sufficient size. And so that's what we've done here. That becomes the target proceeds number. Once again, there's the reserve fund, cost of issuance, underwriter's discount, and all those kind of things to have to pay for. But one is able to show all of those cash flows and have everything sort of flow through it and adjust the savings. What one will observe here is that the savings level, overall savings level now, the net present value savings is lower because the establishment of an escrow, which is that you need to you need to invest at some kind of interest rate, which oftentimes is less than your borrowing cost. That creates an inefficiency. And on top of that, in this particular example, and in any example, whenever you have to include non-callable bonds, you also end up reducing savings. So whereas we had about 5% savings before, now in this example we have we have just over 3% savings, and that's what it is. And then it is possible actually for one to take the next step, actually similar to how we had done other cash flows, to adjust the principal amounts here in order to make sure our contingency is within $5,000 but still greater than 0, and all those kind of things, and all of it sort of flows out and works perfectly. The savings should stay roughly about the same place. And that, in a nutshell, is how much sort of the complication that an advanced refunding introduces into this. Does anybody have any questions on this?
Yeah, we've got a question on this slide, slide 11. Your cost of issuance. What is a good benchmark for local governments to use as a cost of issuance? Is it a percentage of the bond proceeds, or are those actual costs?
That varies widely across issues, and there's no one single number that's accurate. If one were to try to come up with a good estimate, my suggestion would be to come and go look around on Emma for OSs for deals that are similar to your own in terms of both size and credit. And from that, if you grab a few of those examples, take an average, that's probably the best proxy of what it would be, because it varies widely. The rating agency fees, for example, which is one component of cost of issuance, is proportional to the size of a transaction in general, but they also change depending on the type of credit and the frequency of issuance. Legal counsel is the same thing. Different credits a lot of times because of the complexity of the transaction, commands different levels of costs. And the same for financial advisors, the same for title insurance for lease deals and things of that sort. So the best thing to do is to really look for similar deals to the type of credit you're doing, similar sizes. And if you're in California, also look for California ones, because I think some costs and requirements are certainly state-specific, and to use that as a way to gauge where yours might be. And of course, if you're a frequent issuer of deals, you can just look back at your own deals and see how much it costs, and you'll have a good benchmark as to what that is.
Louis, I think the point is, though, your model includes cost of issuance that are actual costs on this deal.
Yes, that's correct.
Okay. So I've got a couple more.
Okay.
When do you take into account negative arbitrage when funding an escrow?
In this example here, there already is negative arbitrage in that. Not that it's explicitly shown here, but the aggregate arbitrage yield of this transaction is actually more than the investment rate of this particular escrow. And by doing that, you've already factored in, when you use market rates for each component, you will automatically factor in what the negative arbitrage would be. Does that answer the question? That's when you do it. I mean, doing the way that this example is shown, that takes into account already that negative arbitrage. And this is certainly a number that can be computed. And actually, we'll talk about that a little bit in the next couple of slides, how you compute some of those values.
Okay, got a couple more.
Okay.
Other than doing an advance refunding just once, are there other legal tax considerations that limit when you can do an advance refunding?
Well, certainly you wouldn't do an advance refunding if it won't save you money. That's a limitation. And in terms of tax rules, the fact that you can only do it once, that's about it. I mean, That's the biggest limitation, because that's going to be you can only advance refund in a single issue once. I mean, after that, you can only currently refund after that. But in terms of whether or not one would do an advance refunding, I mean, that's all part of as opposed to a current refunding, that's all part of a more extensive discussion, a lot of which will be covered here in some of the later slides. But there are other situations that cause one to have it be that an advance refunding would be more or less efficient. Because what happens when you do an advance refunding is that for a regularly structured series of bonds, that's probably level debt service in the past, if you're doing advance refunding, you're probably leaving some candidates behind, which are the ones that are non-callable. And that might have implications about how the economics and everything else works for you. It may be that, for instance, you're doing a lease transaction. You only have one asset. Now you can't release the old asset unless you take out the old bonds. Well, if you throw in the old bonds, which are, like I just talked about, less efficient, well, you're building in an inherent inefficiency on top of the negative arbitrage and everything else. And at that point, you might decide that, I would be better off not advance refunding something, even putting aside all of the tax rule implications and things of that sort, and just wait for a current refunding where things might be more efficient. So there's a number of situational things, but none of them are really related to tax per se. That would limit advance refundings. Okay. Another question?
Yeah, I'll let you feel one more here. This is probably one you're very familiar with. Is there a quantitative savings that are the target for a refunding that justifies, in terms of net present value savings, that would warrant going forward with a refunding?
That's a good question. That is, in fact, why so many people use the net present value savings percentage calculation. And I think it used to be that, and it may still be for some folks, that 3% NPV savings is the goal. People do a variety of different metrics on that, especially when one is talking about advance refundings, because advance refundings inherently building a certain amount of inefficiency related not only to negative arbitrage, but also some other things. In those situations, one might increase the savings target, let's say 3% to 5% or something else. At the end of the day, there's no firm rule on what it is, but usually people adopt a kind of policy, which I think is one of your future webinars, to serve as a guide for them to justify their actions. Because at the end of the day, one is not supposed to try to read the market, if you will, to try to catch the lowest point possible. Because one can never catch the lowest point. I mean, somebody might get lucky and catch the lowest point, but the other 99 times he's going to probably be not catching the lowest point. In terms of the savings target, it's really just that level which one feels is adequate to match the effort involved. So as I was talking about, it's 3% savings, right? Well, if it's 3% savings and your bond deal, it's 3% counting everything. So you have to count underwrite discount, cost of issuance, and everything else for that matter, everything. So it's total NPV. So if it is 3% savings, but only on, I don't know, $1 million of bonds, maybe $30,000 isn't worth the effort, for that to be done. So 3% can't be a hard and fast rule. Some of it is also dependent on scale and things of that sort, and what the specific situation is, and the kinds of structures one is looking at. I would say the 3% is probably the minimum for a fixed rate to fixed rate bond transaction, where the risks are minimal after the fact. Okay, and it goes up from there.
We've got a couple more, but I'm going to let you return to the slides. If we've got time at the end of the program, we'll come back to these questions. If not, we'll find another way to address those through the website or follow up with the education program. Okay?
Sure. Sure.
Thanks.
The next thing we're going to talk about a little bit is about how we go about estimating what savings are. There's a proof that's on this page, but that's just really done for those who are suffering from either insomnia or who are really into this stuff. And so really what the proof is really just going back to the very basic principle is what NPV savings is, which is the difference between the present value of the old debt service and the present value of the new debt service, and appreciating how some of the functions and equations can be applied and substituted in as to create a form that one is able to just take a couple of statistics, a couple of rates, and to be able to then apply that on a maturity by maturity basis to calculate savings. And essentially, appreciating all of those facts, one is able to do it by basically using two price functions, if you will. And one's able to do this on whether it's on their calculator or in Excel. And in Excel is the example here. And here in this particular example, we have a delivery date of 5/14/14, and the maturity of the bonds is 5/1/20. The call date is 5/1/15. We had an old coupon of 5%, a new interest rate of 2.65%, an escrow yield of 0.25%, a call price of 1% of 100, and a COI of 0.8%. And basically subbing in all of the various variables in the correct places per the formula from the previous place. One notices that you're just using two price functions, doing a subtraction, doing a little division, and one is able to come up with a percentage savings calculation just based on those simple functions. And you know, to come up with an estimation of an NPV savings for a whole series of bonds, one would just repeat that calculation for every single maturity, add it together, and that's your new savings number, your new savings estimate number. One thing to recognize is that all of these are estimates. There tends to be synergies or, when you refund multiple bonds at the same time, or sometimes there could be certain inefficiencies when you aggregate things together for whatever reason. And also, this kind of calculation obviously doesn't take into account release of reserve funds and things of that sort. So this is really done basically as to help somebody guide them whether or not they should start looking more seriously at the transaction, to engage somebody to help them run all of those numbers, or if they have the savvy to try to do that themselves. And this is how you do it. One other thing I will point out on these calculations is that the new rate, and I use the rate here because just to make it very clear, it needs to be the yield to maturity on the new refunding bond. So to the extent you have callable premium bonds, you need to follow all the pricing conventions and things of that sort to solve for the yield to maturity. But if the replacement bonds are non-callable region, you can just use the yield. But it's not it's not just the old coupon or the old. It's not just the new coupon or the new yield. You need to really look hard at figuring out what is appropriate. Is there any questions on this? Because this is, or any part of the refunding, because this is really the last part of the refunding.
I've got a couple more if you want to handle them. I just wanted to make sure you were able to get to the
make it through
content. Yeah.
Okay.
But people could stay on. No, I'll ask a question. Slide 11, you've got on the uses of funds a line for contingency. It's represented as a negative number. Why is that?
I didn't want to just change too many things on this one slide. If you go back to the first webinar, I'd gone through many different iterations, each one taking a single step. What I would have technically done for this is I would have had, you know, in the interest of time, I didn't have that additional slide prepared, but I would have done another slide where I would have resized the new principal amount, so the part I'm running my arrow over right now, such that I would generate more proceeds at the eliminated contingency, or bring it down to within $5,000, but still a positive number. So really, this is the problem here isn't quite finished. I'll say that. Okay.
Okay. I got another one. Why is the net present value saving measured as a percent of the original principal and not the present value of original principal? Wouldn't that be a more accurate measure of savings?
That brings the question of what is the present value of the original principal, of the original debt service. The reason you do it based on a principal is that the principal face amount is already sort of a discounted value, if you will, because in order to account for some kind of present value, you should also have to inflate these by interest. So the present value would really be the present value of the debt service of the old bonds. That just adds more complication and doesn't necessarily make it any more meaningful. The intent of these measurements is to give a scaling factor that, so that one can come back and have a feeling if whether they did a $50 million refunding versus a $25 million refunding versus a $100 million refunding. There's some level of comparability. That's really all that's for. And doing against the old principal amount is a convention that's been taken because it's not something you can change. Once you, that's just a fact, as opposed to if you do it against new principal amount, you can actually mess with how you come up with principal amount by having higher coupons or lower coupons and things of that sort. Using the old principal amount is not something you can change, and it creates a consistency across the board for people to make comparisons.
Okay. Even if there isn't a net savings, is it worthwhile to do an advance refunding for cash flow purposes?
You really have to look hard at how you're getting the cash flow savings. I would say generally no. But it's really not possible to get cash flow savings unless you are either contributing a lot of cash into the transaction or you are liquidating an old reserve, in which case you're really, in a way, borrowing from the future because that old reserve would have been used to pay for the last debt service payments of the bonds. So basically, essentially you have just liquidated. You've just incurred a future obligation to create near-term cash flow savings. And in that case, if that was the case, there are probably more efficient ways for one to get cash flow savings anyways, such as getting some kind of credit enhancement, be it a surety bond, a letter of credit if your indenture that allows for it to get that cash flow savings, and still fulfill your reserve fund requirement.
Okay, if you want to take one more, I've got one more.
Okay, I'll take one more.
All right. Is there a benchmark of savings relative to negative arbitrage that should be targeted in a refunding? For example, should the savings be twice the amount of the negative arbitrage?
There's a lot of people that do use that rule. There is no hard and fast rule on that, really. At the end of the day, there are other metrics. If that metric isn't convincing, there are actually other different ways of evaluating the problem, some of which may provide a more intuition or be more intuitive to interpret in terms of if it makes sense for you. But I've seen that metric be used, and at the end of the day, should it be half? Should it be 60%, 70%, 80%? It's impossible to really know. Certainly, if there's no negative arbitrage, you should do it, and it meets your savings level. But short of that, there's always going to be a bit of a judgment call, and it may be worthwhile to look at other ways of looking at the problem to come up with a decision of whether or not to do the refunding. And actually, if you stick around, there'll be some of that that'll be talked about here in terms of looking at call option valuation if we manage to get to the bonus material. Okay.
One last thing on slide 13 in your formula for net present value savings, you use B9 cell. You call out B9. I'm wondering.
The question is that's supposed to be B8.
Yeah. Okay.
Yeah, that's a typo.
Great. That's it. I'll let you go.
Okay. The next thing we're going to talk about is the economics of callable bonds, and it was important to introduce the topic of refunding first because at the end of the day, the only value for having a callable bond is really, for the most part, is really for municipalities is really that you can use the call to refund it to generate savings in the future. And so it was important to have an appreciation of how refundings work before we talk about it. And last time during the, part one of the webinar, we talked about pricing and how prices can deviate from par, that is, deviate from 100%, so that if you have to purchase a certain principal amount, the actual price you deliver is not equal to just the principal amount you're buying. And really, we also talked about people use yields to express those prices because it provides more comparability, and a lot of it, some portion of the last webinar was dedicated to how to convert that yield to prices. Well, one of the things that we didn't do is really to look at whether or not some of the methods we had used and some of the calculations we had done really faithfully does that translation of yields to prices. And here we're going to talk a little bit about that because it does then relate to how callable bonds that are not priced at par are affected by having yields that do not equal the coupon. Here I've put out a formula here that's supposed to represent what one's total net return is. And for anybody who's ever bought an income-generating or a cost-incurring asset like a home or a stock, a rental home or a stock or something of that sort, you come to the realization that the total earnings one gets is not only the income or the cost that one has along the way, but also the original acquisition price and as well as the price at which you dispose of the asset. And this formula sort of captures all of that in that it's looking at the difference between price at one point in time and the price at the previous point in time, plus the coupon that's related to that particular bond, in this case a municipal bond. And when we have these premiums and discount bonds, what generally happens is over time the original prices, which are well away from, maybe well away from par, drift towards par at a later point in time, such that an investor's total return is equal to the coupon plus the movement of the price over time. And looking at this example here, this person has $100,000 of a bond at a coupon of 4%. He bought it at a yield of 3.5%. And between date 1, 5.14 and 5.15, let's look at his overall economics. Using the price conventions and formulas and things of that sort, here are the two prices we get calculated. This is the price for 2015. This is the price for 2014. You notice that there's a drifting towards par that is towards 100%. And his total rate of return is the change in that price plus the 4% coupon he receives. And all of that adds up to multiplied by the $100,000 ends up being $3,748.01, which is actually 3.5% of $107,149. And it's 3.5% of this amount because this was the original price he paid. When you multiply price against the 100,000, that's how you get that number. So that's what the yield means. It's a representation of his amortization of his price as well as the coupon. It is the rate of return he gets for the asset he owned over that period. And when one looks at this over time, here the numbers of the prices appear right on top. These are the same as the ones on the prior page. Over time, it gradually goes towards 100%, as I was talking about. And so I took the difference of each of those steps that change the value, as well as the coupon he receives. And when you add it all together, that is his total earnings value, if you will, on a percentage basis. But when you adjust it by the value of his original asset at that point in time, so here, as in the example, the 3748 would be divided by the 107, but at the end, you're going to divide it by a much smaller amount. But when you do that division, you'll notice that the effective yield is consistently 3.5%. So the yield is the constant rate to get an equal rate of return after accounting for the amortization of principal, the amortization of premiums and discounts, and that's what it is. And that's how it works. And what throws a wrench into all of these things is when we have callable bonds and we have those municipal bond pricing conventions. And the first of those examples we're going to look more closely at is how callable premium bonds work. From our webinar, our first part of our webinar, you'll recall that for callable premium bonds, the pricing is done to the call date generally, as opposed to maturity. And what that means is that the full amortization of the premium will have happened when you price something to the call date. The full amortization of the premium would occur by the call date. At the call date, the price would then, from then on out, be 100%, or the call price if you have call premiums. But at that level and stay steady at that level. And when you look at that, what that means when you apply it to the same formula and you look at that period crossing over and past the call date is that because the prices are not changing, the only rate of return he's getting is his 4%. This is coupon. And when you divide it by the value he has on hand, what ends up as a calculation is that his rate of return after the call date is equal to the coupon. And that's all it's equal to. It has nothing to do with the yield. And looking at a stream of cash flow similar to the way we had just looked at it before, so for the entire period before the call date, there's an amortization of total value where he's consistently at the stated yield he bought it at. But over time, after that date, after the call date, so which is in this example is 2024, his total return value is for each period is the coupon. And when you average these previous periods of 3.5%-ish return against these 4%, the more 4% periods there are, the higher your cumulative rate of return will be. So as long as he's not getting called out, his effective rate of return on average for the whole holding period will be progressively higher. And if the bond was to stay outstanding till maturity and would never be called, his return is substantially higher than the nominal yield of the 3.5%. In this case, it's actually 3.702, which is 20 basis points higher. And that number that represents something standing at the callable premium bonds outstanding to maturity is what's known as the yield to maturity. That's just what it's called. And this becomes another metric that people use to really measure the cost of borrowing for these callable premium bond structures. Okay, anybody questions on this?
No, we're good.
A similar phenomenon actually exists for discount bonds. Once again, for all these bonds that are priced at premiums or discounts, there's a gradual drift from the original price you price it at towards par. So for a discount bond, the original expectation would have been it would have taken till the maturity date of the bond, which is much later, to fully amortize all of the discount. But if one were to redeem the bonds early, one actually disrupts that amortization. Here we have this example where the person had a 3.5% coupon bond with a yield of 3.75, so a yield higher than the coupon. He had a maturity date originally, it was supposed to be 34, but he also had an optional redemption date of 24. In this case, the bond gets called. He was going to amortize the original price, which was solved to 96.504 over time, to following the same mathematics before, to have a consistent rate of return of 3.75%. And if the bond had not been called, this will gradually go up to 100, somewhere down here, such that the rate of return would be consistently 375. But here, because he's disrupted where when you call it, you're going to pay him par to face value. When you do that, he's actually getting more than just the amortization of the price plus the coupon. Instead, he's getting the coupon plus whatever his current accreted value or the remaining unamortized amount of the discount. And when you add those things together, you end up with a rate of return that's substantially higher. And so for discount bonds, this becomes a sort of a hidden call premium, if you will, if you were to redeem the bonds early. And this hidden call premium doesn't just apply to optional redemptions, but actually also applies to regular sinking funds of term bonds. So that's why a lot of times you do see discount term bonds, because and investors are interested in that, because while it is an additional cost to the issuer, the flip side of that is, of course, it's an additional benefit to the investor. And that's why they like it. Okay? And so this sort of cuts both ways. So really, when you look at callable bonds and how the economics work, this is a table that quickly summarizes what all of those terms mean. The stated yield on a par bond represents the actual yield of the par bond. For the premium bond, it represents the yield to the call date. For discount bonds, it represents the yield to maturity. So it's not really necessarily all the same thing. And the same is true for the yield to maturity. For the par bond, it does represent the actual yield. For the premium bonds, it represents the worst case scenario. That is, one doesn't actually ever redeem it. And for the discount bond, it actually represents the best case scenario, because if one were to redeem it to the call date, one would actually incur additional cost there. And the yield to maturity actually represents the best case scenario and taking the longest and the full period to amortize the discount back. For refundings, callable bonds, par is sort of neutral. It is what it is. For premium bonds, it's more likely to happen because it's easier to generate, to make the 3% MPV savings threshold, because the calculation of the economics for refundings is based on the old coupons and the new replacement yields. And by having higher old coupons, it's easier to make that metric. Conversely, for discount bonds, it's the other part, where now you have a low coupon. It's which is what a discount bond generally has, and becomes unlikely to be refunded. But also, if you do a refunding, it incurs your hidden costs of instantly fully amortizing any remaining unamortized, fully realizing any unamortized discounts. So the one thing really for all of this is that one should think about whether or not it's appropriate to their particular scenario to use a particular structure. For par, because much of the market is pricing premium bonds in this low interest rate environment, the comparison should really be that if you're going to do it at par, that the overall economics makes sense relative to the market standard of having premiums. But for premiums, whether or not to do those really should be about whether or not you think it's likely that you're going to do a refunding in the future. Because if you don't think you're going to do a refunding for whatever reason, for instance, one reason would be, the remaining outstanding maturities is too few, too small. So let's say you had a bond that you were issuing, it's only a 12-year bond, you're going to have a 10-year par call. There's only 2 maturities where you can refund for savings. If you look at those 2 maturities and the size of most maturities, and you're convinced you're not going to do it, you hope you're unlikely to do it because of sort of the fixed cost of issuance or the hassle, then probably it's not a great idea to have callable premium bonds there. And on the flip side, for discounts, you can cause an increase in the cost of refundings in the future, and it creates hidden costs for term bonds that's not immediately obvious at first glance. And this table just summarizes what callable bond economics look like for different coupon structures as expressed in price, whether it's par, premium, or discount. Are there any questions at this time?
We've got one. Why is I think you may have touched on this. Why is the net present value savings measured as a percent of the original principal? Yeah, you already got to that. Yeah. Okay. Sorry. Nothing other than that.
Okay. Hopefully some of this callable bond economics makes sense to folks, and why you do certain things and what some of the nomenclature means. So given all the complications of callable, of the pricing effects, of refunding impact, of all these things, when you have premium and discount bonds and just this and that for callable bonds, you might think, well, maybe we should just go with non-callable bonds. Makes life easier, right? Well, that's about the only thing it does, to be honest. So the standard bond for bonds longer than 10 years right now is really to have, unless you're a lower rated credit, for the most part, it's generally to have a 5% coupon, which in this market, given how low interest rates are, is a premium, and callable in 10 years. And the thing that you would be looking at for a non-callable bond for the market to really accept it would still be a premium bond and be non-callable. And I think the one advantage of it is that really it does simplify the math in the sense that the nominal yield is the yield to maturity, is the yield you'll be paying, and all that kind of stuff. But the disadvantage of having a non-callable structure is that you won't be able to do any future refundings for potential savings in the future, and also that there are certain tax law and arbitrage implications related to giving up your 10-year par call, or having even just a par call, or having call more than 10 years away, which will also be giving up. And so the analysis of figuring out whether or not this future refunding is worthwhile, is actually as, if not more complicated than the math of calculating something on a yield to maturity basis. Okay? Here, I've just set forth some of the economic analysis that one would look at when you're looking at non-callable bonds versus a standard bond. Many of the terms here are the same. We have the same delivery date, the same maturity date, the same coupon, because once again, non-callable bonds, investors want to retain that, quote, above market coupon, if you know, if you want to think of it that way, with greater certainty. And that's why almost all non-callable bonds are premiums. The yields, they're going to be different. In the current market, it is such that non-callable bonds are actually higher than the nominal yields for callable bonds. That's just the way it is right now. That wasn't always true, but it is true in the current market in general. For the callable bond, we had a 10-year call. Of course, that's not applicable at par. And for non-callables, of course, that's not applicable. And when you use these terms and follow the rules, you come up with a price of $111 and change for the callable bond, $115 for the non-callable bond, and the price is actually higher even though the yield is higher, because remember, once again, price and yield are supposed to work inversely, where yet higher yields tend to be lower prices and lower yields tend to be higher prices. But that is not followed here because for the non-callable bonds, you are pricing to maturity, whereas for callable premium bonds, you're pricing to the call date. So that's why the price here is higher. The yield to maturity in both, and the nominal yield in both cases for the non-callable bond, not that you have a choice to redeem it 10 years early, is going to be consistently equal to the nominal yield. But for the callable bonds, different. And this is where you start to see the difference. Here, the yield on the standard structure is lower, as we talked about, than the non-callable bonds in the current market, but the yield to maturity is actually higher. So really, whether or not the standard bond is going to be better or worse than a non-callable bond, assuming you're not getting gobs of savings in any way or form in the future, and just looking at the first transaction, is really going to depend on when you end up redeeming the callable bond. And when one looks at whether or not this 388 is better than the 366 or the 4173, there's a variety of tools people go about doing that. One is to do a call option calculation. Some of the calculations is really to do break-even calculations to figure out, what future interest rates would it have to be that this would get refunded to cause this to be equivalent. And how does that relate to where current interest rates are, what kind of NPV savings is that. People then decide whether or not it makes sense based on some of these break-even metrics or this call option. And this is, if we get to it, this is the part of the bonus material we're going to talk about a little bit more about whether or not those things make sense and how that metric is done. Okay? But historically, what has happened, and I don't know, it's a little difficult to see here, and historical data is not complete, but what recent history shows is that non-callable bonds have underperformed versus callable bonds. In these two graphs, the left-hand side is for 20-year bonds, the right-hand side is for 30-year bonds. What I did was I graphed the yields according as represented by AAA-GO MMD, for 20-year bonds at each moment in time, and then also the very thin blue line, I know it's really hard to see, which is basically on top of the red line, is what it would be for the callable structure. So from a nominal yield perspective, the callable and non-callable are very similar. But when you factor in the refunding that would take place 10 years later, which is why the line stops here, because this represents the yield back in 2004, plus a refunding taking place in 2014 in aggregate, you'll see that the all-in call for the callable structure plus the refunding results in a lower total rate than the non-callable structure. This is not that surprising given that interest rates have been low and that we're in a declining environment. But the other thing really to recognize is that in a normal yield curve, in a normal environment, even if interest rates just froze in time and never moved again, when you start with a 20-year bond in the first place, when you refund it, you'll be able to move down the yield curve such that with the replacement refunding, such that after 10 years you'll be paying a 10-year rate. So that really you're only paying the 20-year level, if you will, for the first 10 years, and for the rest of the time you're paying at the 10-year level, which is why, generally speaking, absent interest rate movements, it's still advantageous to have the call. And on top of that, in the current market, actually, the non-callable yield is higher than the callable yields. Only time will tell whether or not, for this remaining period, it really would have been beneficial, whether, at the very bottom here, it would have been beneficial or not. But for now, at least, for the historical data that we have, in recent periods, it has been advantageous to have the call. Any questions on any of this?
No. Go ahead.
Okay, next thing we're going to talk about is CABs and convertible CABs. CABs being capital appreciation bonds or zero coupon bonds, and convertible CABs being a hybrid version of capital appreciation bonds and current interest bonds. And just to lay a couple of things out, capital appreciation bonds generally are non-callable. They generally are long. They generally have higher yields. And the reason people end up using these higher yield instruments that are non-callable, not very flexible, is really because you don't have to pay any interest. It's the zero interest loan for now. And two applications of that is shown here. One is that sometimes you can reduce near-term debt service by deferring principal, for instance, which is what the top graph shows. But sometimes that's not enough. And so in order really to get to this gray part, one would have to either capitalize interest, that is, set up an escrow fund to pay for interest, or you could issue CABs to do that, because CABs have no interest, therefore there would be no interest payments, or at least that portion of it would be reduced proportionately. The other reason people do it is that there's some kind of structure where they're trying to bond to a projected pattern of revenue growth, and it is such that the revenue growth pattern is sufficiently steep as to disable somebody from fully leveraging the expected future revenues. And that the way to really do this, by the fact that the current interest is already eating up the entire amount of revenues, and that the only way to incur more debt and still fit within this revenue pattern is to issue some kind of debt that doesn't require the payment of interest, and hence CABs. And this frequently happens for something like a toll road, for instance, where you have inflation and increase in traffic and things of that sort that cause revenue growth to be steep and justifiably steep. Okay. That said, even though there are uses for it, there is certainly a price for using CABs. Here I've graphed some current interest bond. That's what CIB stands for. So this is CAB yields as of a certain date, which is about a month ago at this point. And you'll notice that the current interest yields are substantially lower than the CABs, and that's shown the actual numbers on the bottom table here. And not only are the yields substantially different, this difference is probably a bit understated, I would say, because these are AAA GOs, and CAB spreads tend to widen even more as one moves to lower rated credits. Not only is the yield different, but one of the things that's really strikingly different a lot of times is the interest to principal ratio, which is to say how much total debt service will be for every dollar you borrowed, how much more debt service will be for every dollar you borrow. Whereas for a 30-year bond at a 3.24%, that's about half. Once you take out everything for cabs, that's going to where for that it's about double. For cabs, you're going to be making it 2.67 times higher, so it's like almost 3 and 2/3 times larger for total debt service for a 30-year cab. Okay. Now, I think one of the things that people will come to realize, well, but cabs give us structuring flexibility, right? It gives you the ability not to have to pay interest. Is that worth something? Yes, it certainly is worth something, but it's actually not nearly worth as much as what the market is charging for it. And it's actually possible to do some math to go figure out where cab pricing should be. And how one goes about doing that is one builds a structure that includes cabs and without cabs. And you set it to be such that the two structures end up with the same debt service and the same proceeds level. And if those two things are equal, you get the same proceeds and have to pay the same debt service. Those two structures must have the same cost, right? Well, if we were to structure it such that we only introduce one cab at a time, it's possible for one going through these steps, I'm not going to spend the time going through here, to impute what the fair mathematical value for a cab would be relative to a current interest bond. And in the lower right-hand graph, I've graphed that out, and what one sees is that the imputed zero coupon rate is a lot lower than what the market actually charges. And that's just the way it is in the current market, and it has been that way for a very long time. I don't know when it has deviated from that, but every time I've ever looked at it, which is too many times at this point, that's been true. And the difference is substantial. It's not as if the imputed value is very close. It tends to be very wide. And that's really some of the additional costs of the caps. Going back to that whole principal to interest ratio thing that we're talking about, one of the things that people, critics of caps, will have oftentimes is really talking about how many times debt service becomes. And the fact that you compound the rate of return on caps is what magnifies the effect. Not only that, cabs also have higher rates, as we just saw. All of that lends itself to that. And on top of that, the cab structure itself creates that. Whereas issuers, at the end of the day, bonds are two sides of a coin in that when something is economically disadvantageous for the issuers, it's something that's economically advantageous for investors. So it's not a surprise that investors have a preference for structures with cabs that are beneficial to them, which then end up being a fact that that do not benefit issuers. And cab investors generally prefer very long-dated maturities, and the interest rate penalties also tend to increase with those longer-dated maturities. And cabs also tend to be non-callable for the most part, which then just compounds the issue because once an issuer is down that path, there's no real ability for them to take out the bond in a refunding or restructuring or something of that sort to correct the problem. They're stuck with it forever. And on the right-hand side of this page, I've graphed how much the compounded interest tends to expand over time for different interest rates from 4 to 8%, and from 5 to 40 years. And here you'll see that at the end of 40 years at an 8% rate, this is it's not 25 times the amount you borrow, but certainly more than 20 times the amount you've borrowed. And even shorter maturities, it can be quite a lot. And when you go out far, that just gets compounded very, very quickly. Any questions about any of that?
No, Louis, you might want to highlight last year's legislative restrictions regarding cabs, both with regard to debt service ratio and the call factor.
I don't recall right off the top what those ratios are, but yes, as this is pointed out, there were legislation that attempted to cap, because of these issues of how many folds some of these numbers are. Optically, it's very poor to issue caps in terms of tying future generations' hands in terms of how one finances future needs. And what was the ratio? Was it, I forget.
It was 4-to-1, and there is a
10
ball
that's
now.
Right. Yeah.
Okay, just wanted to note those.
And it doesn't take much to go past 4-to-1 here, as you see. Much of the graph does. Okay. Do we have any questions at this point? After this is just the bonus material, so
no,
happy to
you've covered all that have come in up till now.
Okay, fantastic. The last thing I want to just talk quickly about is how people go about value and call options. We're not going to go through in detail each and every single method and what it is and how to go about doing it, because some of it just takes way too much math to do and it's well beyond the scope of what this is. But it's important, I think, just to have a quick understanding of some of the underlying things about each of the methods that are commonly used, because some of those, sometimes it gets to be that people, in my opinion, put too much faith in some of these methodologies without recognizing some of the shortcomings to doing it. And also sometimes, as one of the questions that were asked before, a single method proves inadequate or unconvincing in terms of whether or not it helps in the decision-making process. And hopefully by showing you what some of the other options are, it may be that one is able to either request somebody to provide analysis in a different fashion, or maybe look to something else that they get better comfort from. Okay.
Louis, if I could just mention, we are at the end of our allotted time, but we're going to let you go ahead with the bonus material. Recognize that people may drop off through the course of it, but we'll let you go forward with what you prepared here.
Sure. This is only going to be 3 slides, so it should be fairly quick, or 4 slides. The first thing I'm going to talk about is there's basically 3 approaches people go about to looking at call option value as depending on question. The first of those is something that people, as a person brought up earlier, which is savings relative to the negative arbitrage. That's sometimes referred to as refunding efficiency. And what that is, there's a number of different things that are called refunding efficiencies. But one of them is this, which is mathematically, it's just that the NPV savings you can get now divided by the sum of the NPV savings plus negative arbitrage. And as that person had asked, is half a good number? That's a good question. Some people look at that and say half is good enough, and that's what we would use. And this really has limited application. It's really just used to determine whether or not you should advance refund or current refund in the future. And the primary advantage of this method is that all of the inputs are something that you can know with the current market. Some of the other methods are going to be based on things that are really not knowable or are based on theoretical math that may or may not prove to be true over time, that requires more prediction. This particular method doesn't have any of that. And so in that way, that's why it's liked. The second of those methods is what's called the option valuation model. And what this is there's a bunch of people who are very smart at math and who's been doing finance, quants, who come up with different models for how to project interest rates into the future and at different points in time. And what one is able to do then is to take those interest rates at different points in the future, use calculations similar to some of the estimating savings that I described above, to calculate what savings would be, and then somehow to collapse all those different possibilities into a single number, and to represent all those things into a single number. People tend to like this method because it's very useful. It's somewhat magical in the sense that there's this one number that can capture what a call option is worth. But it's also worthwhile that it's the one method that you're able to analyze multiple different options at the same time and give them comparability. And it represents a market perspective on what future interest rates would be. A lot of this math that they use to come up with these future rate scenarios is based on hedging strategies, hedging instruments, and things of that sort. So this is where one of the shortfalls of this method is that at the end of the day, yes, all of this math is correct and accurate because it represents what you can hedge at today at those future interest rates. But guess what? None of the issuers actually hedge those positions. So whether or not that math is correct doesn't mean anything in the sense that the future might not actually be whatever these math models sort of predict. If you were able or willing to do the hedging, it would perfectly predict it, but you're not. But issuers generally don't, and that's where the shortfall happens, is that the predictive ability of some of these math models hasn't really worked out. For the most part, most of the predictions have been that interest rates are going to be higher than where they are now. And over time, that hasn't proved itself out. Another method to do is what is known as a break-even analysis. And in that case, what you do is really you look at two different scenarios, and you find what future interest rates have to be such that the two scenarios would be at the same place. And that's known as the break-even interest rate. And you use this to consider two different alternatives, such as like different refunding, that whether or not you advance refund or current refund in the future, you can come up with what the break-even change in rates in the future would have to be to wait for the current refunding, what interest rates would have to be for the current refunding in the future, such that gives you the same economics as advance refunding today, for instance, or different coupon scenarios even. And this method is liked in the sense that the results are easy to understand, and it doesn't rely a whole lot on assumptions. One of the things inherent in the option valuation model is that there is assumptions about volatility and things of that sort, which are maybe hedgeable, market-provided data points, but they're still assumptions in the sense that the issuers don't lock in those market-provided data points, and therefore the market-provided data points are no better than just merely assumptions. And the break-even analysis approach doesn't do any of that. There are also some hybrid approaches that make use of more than one method. For instance, there's an alternate refunding efficiency calculation where the refunding efficiency is just MPV savings divided by the option value, and the option value is the one that comes out of the option valuation model. That's sometimes referred to as refunding efficiency. And then sometimes people do the break-even analysis, and then depending on, with the break-even interest rate in hand, they do some kind of statistical probability analysis similar to how option valuation model to come up with confidence level of whether or not that interest rate is likely or not. So you come up with, okay, we run a Monte Carlo simulation or something of that sort, and there's, there's a 75% chance the rates would be better than that or not, or something of that sort. And that's an alternative way of really combining the option valuation approaches and strategies with break-even analysis. And these 5 things basically encompass the universe of different things that are used to evaluate options values in municipal finance. Any questions on this for right now? Next, I'm going to go through basically talk briefly about the top 3 methods and some of pull back a little bit of the curtain of how some of these things work and things to think about with respect to them.
Nothing yet.
Okay. The refunding efficiency, which is the only one we're going to talk about how to do the math on, is because we already basically did all of the math before. On the slide, I forget exactly which slide it is, that it talks about calculating, estimating refunding savings in Excel. It's basically using the exact same method because you have all the pieces there. And, oh, there, slides 10 and 11. And basically just adding the negative arbitrage component. And the formula here shows exactly how all of that is done. You'll see which two, it's a repeat of sort of the same terms again and again to do that division and addition. And and two parts of it is identical, and then the other parts of it is identical. The one new piece, if you will, is the very last term here, the price, which is just taking the price at perfect escrow, which is the escrow assuming the escrow cost, assuming that one is supposed to be able to invest at the escrow yield, is able to invest at the new replacement rate, and that's it. And that's all the math there is to it. And as the escrow yield approaches the new rate, what you'll see is that the efficiency percentage gets up. But really, probably conversely, what is true is that what one notices is that as the new rate is closer and closer to the escrow yield, then the efficiency percentage goes up also. And how does that happen? That really happens if you are borrowing at a very low rate by refunding, for instance, a very short maturity. So bonds that are, let's say, callable in 5 years from now, but you're only refunding a 7-year maturity, for example, because 7-year rates are so low, even though 5-year rates in treasuries or slugs or whatever isn't very high, you can get to a very high efficiency percentage. So this efficiency metric has the tendency of favoring refunding very short bonds, at least in the current market in the way it stands. Okay, and so one has to sort of appreciate that to know whether or not to recognize some of the limitations and how this analysis tends to bend results. Okay, any questions on this? Okay.
No, Louis, nothing yet.
Okay. Okay, the next thing I'm talking about is how option valuation models work. I talked about the fact that basically what these are is basically some very smart guys come up with some math methods to come up with projections of future interest rates at different points in time. And then what happens then is, so where current interest rates are, but then they have, all different cases of different scenarios as you go into time, the variance in interest rates widens. And what ends up happening is you then take, using the same method as estimating NPV savings we talked about, you're able to calculate NPV savings for each rate and at each point in time at each of these nodes, if you will. And then to collapse the nodes back, to pull all these nodes back into a single number. And how that gets done is that basically a lot of times it's done on a binomial basis, and where an interest rate scenario, after rates have gone up, the prediction is it will either go up even higher or come back down slightly. If this is the case, we have a certain savings number that's associated with this node 3.1, if you will. Let's say we calculate that number, and that's, I'm going to say it's NPV savings of 6%. The 4.1 scenario node, because it's a higher rate later in the future, maybe the savings is 5%. And maybe it is that the 4.2 scenario is 8% or 9%. Well, what ends up doing to collapse all of that is to say, okay, the likely scenario that would have led to 4.2 and 4.1 is really starting at 3.1, node 3.1. And so you take the average of those two scenarios, compare it against this, and whichever is the higher one, you take that one. And then you keep repeating that process again and again and again. So these two collapse into here. These two collapse into here. So 4.1, 4.2 collapses into 3.1. 4.2, 4.3 collapses into 3.2. 4.3 and 4.4 collapses into 3.3. And then you continue the cycle. So 3.1 and 3.2 collapses to 2.1. 3.2 and 3.3 collapses to 2.2. 2.1 and 2.2 collapses to 1.0. 1.1. And if you keep doing that, eventually you end up with only a value for one node, and that becomes your option value. And that's how it is done. And what ends up happening is that these results are very much dependent on how the interest rates themselves are modeled. I think it's pretty standard to how to do the time periods, what one and when, whether one does it more frequently or not. Typically what one does is does it on a semi-annual basis, because we have semi-annual coupons that make some of the math easier. That really has a very little impact on rates, but depending on how one models how different the rates are, how wide they spread, or how narrow it is or where the base point is. Here I've drawn something that's very symmetrical, but it is equally possible to have a triangle where rates never go too low but always go too high, and things of that sort. That can very, very much distort the results. And it's important to recognize that that is true. And what has happened for the most part when you look back at the 10, 20-year history of these models right now is that they've tended to predict interest rates would be higher than where they are now. And as a result of that, their valued option value has tended to be undervalued for the most part. And so is that always going to be continuing in the future? Who knows? Nobody knows until it's well after the model has been employed. But it certainly has not had a great track record, I'll say it that way. And there's a lot of math here, and sometimes it's hard to tell what is going on. Okay? Any questions on this?
No, we're good to continue.
Okay. And the last one of these, the three types, is really the break-even analysis. And the break-even analysis is really a two-step process. I call it step 1 and steps 2 because the second step really requires a lot more work than the first step. The first step is pretty straightforward, which is to take one scenario and the two different scenarios, and typically what ends up happening is one scenario appears better than the other on at face value, assuming nothing else happens. But then you introduce the possibility that under the worst, the less good of the two scenarios, it's possible to refinancing. And when you take into account the refinancing, it may be that that scenario then outshines the first scenario. And there's some point where the refinancing is at a rate such that the refinancing plus the original part of the worst scenario is the same as the better scenario on a standalone basis. And that interest rate at which that happens is called the break-even rate. And that method is fairly straightforward to do. You can, a little creative use of some of the estimated savings, NPV savings with Excel that we talked about in slides 10 and 11 can get you there. But really, the challenge then becomes what to do with that information, what to do with that break-even analysis. And there's really a couple of different ways of doing that, and that's why, and oftentimes one looks at more than one to get a good feel for what they're looking at, and that's why it's steps in plural. First thing to do is to really look at that break-even rate and just compare it against current rates. So let's say you have a scenario of a premium coupon or a discount coupon for the same bond. You would look and you would say, okay, it's a 20-year bond right now. 10 years from now, we can refund it with a 10-year bond again. The break-even rate for the higher coupon scenario is, I don't know, 3.5%, let's say. You would then look at that 3.5% and compare it to what 10-year rates are now, because for a 20-year bond, 10 years from now will be a 10-year bond. And then you would just take that difference and say, okay, that change is 300 basis points maybe. I don't know. Maybe I exaggerate. Maybe it's 200 basis points. Is that likely or not? That's the first way to look at it. It's a really good way of looking at it when you're really assessing a very near-term alternative, because at that point, if you only have to wait, let's say 6 months, and the movement is 200 basis points, you're pretty convinced that it's not going to move 200 basis points in 6 months. It could, but that's a really outside chance of doing that. And in that case, really the accuracy of your outlook is very accurate, or you have a good feeling that's pretty reliable. That's a really good way of looking at it, okay? But sometimes, you know, you're looking at rates that are out 10 years from now or whatever, and you're looking at a break-even of plus 150 basis points. At that point, it's more difficult to tell if it's appropriate. So you can choose one of the other methods then. One way to do that is to compare the result against his history. So let's say we come up with the same analysis. We have 3.5% or whatever it is for a 10-year rate. Well, let's look at where 10-year rates have been over time for the last, let's say, 20 years maybe even, and say, how often has it been 3.5%? How often is it above? How often has it been low? That's really appropriate for sort of a long-term perspective. It's a bit less biased. Of course, there's all that disclaimer about, past history is no predictor of future events, but certainly it can be helpful to be serve as a guide. So if you end up in a situation where your particular rate, your break-even rate is, let's say, in the 80th percentile, and that would seem, and having lower rates is better, then that would seem to suggest it's pretty likely that you're going to be better off. But sometimes that result is ambiguous. What if it's only 50th percentile? Then it's like, well, it's a coin toss whether or not history tells you if you're better off or not. And so there's really another method, or maybe one, or the previous method worked. But there's another method of looking at all this, which is then to take a look at your refunding transaction that was part of the break-even analysis, and really assess whether or not that savings level is realistic. This is important because sometimes that's a very intuitive result. If it were that the break-even NPV savings of a scenario, like the one I just described, a 20-year bond, you can refund in 10 years from now, that NPV savings percentage is only requires to be 2.7%, then it's actually pretty likely you're going to be able to refund it for more than 2.7% savings, in which case it should be convincing to you that, gosh, I'm pretty sure that refunding will happen. I'm pretty sure the refunding will save me even more money, and that seems like a good scenario. And that's another way of looking at what the break-even analysis is that actually moves away from what that rate is per se, and it gives people a feel as to what the results mean. And what they've personally experienced. One of the things that help make it helpful for that assessed savings level is to recognize that if the bond the bond options you're considering is advance refundable, it's worthwhile to think about that, because what ends up happening is if it were that you have scenario 1 and 2, and if you do nothing, scenario 1 is better. Scenario 2 could be better if you manage to refund it, but you would have to refund it and generate, let's say, 15% savings. All of the bonds are advance refundable. Now, if you use the other two metrics, it may be that 15% savings doesn't seem unreasonable. The problem then there is that chances are, if you actually went through scenario 2, you'll probably actually end up advance refunding the bonds issued under scenario 2 well before you get your 15% savings. You probably, when you come along in the market 6 years later, you see somebody shows you a refunding of it generates 8%, 9% savings. Let's take it. In which case, you'll never be able to realize the 15% you would have needed to break even. In which case, that really does mean you probably should have picked scenario 1 in the first place, because you never could actually, it's highly unlikely one could wait and get the high level of savings you need. And that's another thing to sort of look at and try to have an appreciation for in terms of whether or not to do any of this. And with that, that is the end of the webinar, unless some folks have questions, which I'm happy to take.
Well, we can hang on for just a few more minutes. Obviously, we extended beyond the time we'd proposed, but we're grateful, Louis, that you took the time to go through the rest of the material. If we get a couple of questions, we'll pass them on to you. At this point, I want to make sure people do know that are still online, and we've got a good number still hanging on. We will provide transcripts and the webinar on our website to access in the future. Webinar number 1, or part 1 of this series, is already available on the website, I believe. No, it's not. We expect to have that soon. I'm getting nods from my. But we'll have both the transcript and the webinar available in the very near future. If we do get questions subsequent to this, we will try and pass them along to Louis and get answers. Anything come in yet? No, that's it? Louis,
Okay.
I want to thank you very much, both for preparing two lengthy programs, but for hanging on an additional 20-some minutes to present the bonus materials. There is a certificate of attendance that will be emailed, and again, for those needing MCLE credits, please email us at the CDEC email address given on the screen now. Louis, thank you, and thank you to all those who hung on through the extended period.
Okay, great. Thank you.
Take care, Louis.
All right. Bye-bye.